Types of liquidity risks and how to manage them. Liquidity risk refers to the potential of not being able to meet financial obligations when they come due. It's a crucial aspect of risk management that businesses and individuals need to be aware of. In this video, we will discuss the different types of liquidity risks and some strategies to manage them effectively. 1. Funding liquidity risk. This occurs when a company or individual is unable to meet their short-term funding needs. It may be due to an unexpected decrease in cash flow, difficulty in accessing credit, or a sudden increase in financial obligations. To manage funding liquidity risk, it's important to maintain adequate cash reserves, diversify funding sources, and establish relationships with multiple lenders. 2. Market liquidity risk. Market liquidity risk refers to the inability to buy or sell assets at fair prices due to a lack of market participants, or an unstable market condition. This risk can adversely impact asset valuations and prompt financial losses. To manage market liquidity risk, it's essential to regularly assess market conditions, maintain a diversified portfolio, and ensure access to alternative sources of liquidity. 3. Asset liquidation risk. Asset liquidation risk arises when an individual or organization wants to sell an asset but cannot find a buyer at a reasonable price. This risk is common in less liquid investments, such as real estate or illiquid financial instruments. To manage asset liquidation risk, it's important to carefully evaluate the liquidity of assets before investing and have contingency plans in case liquidation is necessary. 4. Contagion liquidity risk. Contagion liquidity risk occurs when the liquidity problems of one institution spread to other interconnected institutions. This risk intensifies during financial crises or economic downturns when confidence in the market declines. To manage contagion liquidity risk, policymakers and regulators must implement measures to enhance financial stability, promote transparency, and ensure that institutions have sufficient capital buffers. 5. Behavioral liquidity risk. Behavioral liquidity risk is characterized by irrational market behavior, such as panic selling or irrational exuberance, which can lead to sudden liquidity shortages. To manage behavioral liquidity risk, it's important to maintain a long-term perspective, avoid impulsive investment decisions, and diversify across different asset classes. 6. Legal and regulatory liquidity risk. Legal and regulatory liquidity risk arises when changes in laws or regulations restrict access to liquidity or require the divestment of certain assets. To manage this risk, it's crucial to stay informed about changes in regulatory frameworks, maintain compliance, and develop alternative strategies to address regulatory requirements. Liquidity risks cannot be eliminated entirely, but they can be effectively managed through a combination of prudent financial planning, risk assessment, and proactive strategies. By understanding and addressing the various types of liquidity risks, individuals and organizations can minimize their vulnerability to financial instability. Want to learn more? Claire Trifle on LinkedIn.